If you're to believe the headlines, the market's crashing. It's 2008. It's worse than 2008. The housing market is going to zero. Well, let's look at the data because that tells a different story. We all know that fear gets clicks, but the reality is not only does it get clicks, but in something like the housing market, it actually can keep people from buying. And as we know, a home is the biggest investment of anybody's life. And it's also where most people in the US create the most wealth. So today we're gonna break down what's happening in the Denver metro market as well as the national market and go through the real figures so you know exactly what's actually happening instead of the doom scroll of market crashing 2008 scenario. And before I move on, just want to say that if you find this information useful or helpful, please click subscribe and like the video because it goes a long way to getting us seen. Before you can look at what's going on in the Denver housing market, it makes sense to take a look at what's going on nationally. Home prices are still up nationally approximately 1 to 2%. Inventory has built and we're sitting at about 4.6 months, which is the most stable that we've seen since 2018. New home sales are at a run rate of about 800,000, which is the strongest since 2022. And total home sales for the year is supposed to be about 4.06 million, which is slightly up from last year, but it's still significantly lower than the average, which is typically in the 5 to 6.5 million units a year. Some markets are still showing strength, like the Northeast. Other markets are showing stronger deterioration, places like Phoenix, Austin, and Las Vegas. A lot of the South and the West. And then Florida is its own market, and a lot of that has to do with insurance issues. So across the board, we are showing some signs of cooling, but by no means is there a crash nationally going on. Now let's look at Denver. Well, you might have seen this headline that said 91% of all homes have lost value. Well, of course, it's misleading, like many of the other headlines that are used for clickbait. And the reality is this is Zillow's number, and it's based on the Zestimates from the 2022 peak to current based on zip codes. Now, again, this is based on the Zillow Zestimate. It's not based on actual MLS data and actual sales. And it tends to be, in this case, heavily skewed towards attached homes and particularly condos, which we have seen lose more significant value. But of course, the headline doesn't break that down, as well as many of the articles and stories related to it. So what do the real numbers look like? Well, according to the September 2025 DMAR report, active listings are up about 14% year over year. Detached homes are sitting at about 2.6 months of supply, and attached homes are around 3.2 months. And remember, a balanced market is typically 4 to 6 months. Pending sales are actually up 15% year over year, and it shows that listings are down from the pandemic years, but stable. About 40% of listings are seeing price reductions, and that's normal for this time of year. As far as pricing, the median price in September was $589,900, which on a year-to-date basis is up 0.67%. Of that, detached homes were up 0.54%, and attached homes were actually down 2.47%. So the real story is prices are stable year over year. There is softening, which a lot of that has to do with seasonality. And of course, if you take a look at the numbers here, where we're looking at peak of 2022 to current, you can see what a normal correction looks like. So based on this table, the peak in April of 2022, and you see some slight softening going into April of 2025 in comparison. And then again in September 2025, prices are down from earlier this year, but year to date, prices are basically flat to slightly positive. And another way to take a look at this is the following chart, which takes a look at the seasonality of home prices here in the Denver market. And as you see, it's very regularly that we see peaks and troughs throughout the year based on seasonality. And this year is following the same trend as we could see in the data from the previous chart. But looking at this chart, what you can see clearly is that the overall market is flattening but it's not breaking. We're not in a significant downturn. And just as the numbers showed, a lot of the negative numbers are related to the attached market, more specifically the condo market, which is going through some pain. And a lot of that is due to higher insurance costs, which in turn flows through to higher HOAs and or problems within specific HOAs that they're not able to cover. Reserves may make the condo complex non-warrantable, which has impacts to financing, things like that. But again, overall, and even in the condo market, there's softening, but there's not an overall collapse like the headlines would make you think. One thing that everybody needs to know about the Denver metro market is it's insanely neighborhood specific. And what I mean by that is you can have two similar looking properties that, depending on which neighborhood they're in, even if they're only just a few miles away from each other, one neighborhood could have homes sitting for 60 days where another neighborhood could have multiple offers in the first weekend. And we're seeing a lot of this in the 900,000 and below on detached homes. And once again, it's very neighborhood specific, and things that go into that are strong school districts, amount of inventory that's been available in certain neighborhoods in the last number of years, etc. But we are seeing a lot of that across the board. And as we discussed a moment ago, things that are showing weakness kind of across the board is the attached market, most specifically the condo market. And that's where we're seeing inventory sitting longer and maybe some more price reductions there. But overall in the Denver market, even though the headlines say that every home out there is getting a price reduction and or major selling concessions, the reality is, according to the DMAR report, there's still about 30 to 40% of the homes that are getting reductions or selling concessions. And that's pretty normal for the overall housing market. It's maybe a slight uptick, but overall it's pretty normal. As I mentioned before, new home sales are expected to make up about 800,000 of the 4.06 million national home sales expected for the year. And that's about 19 to 20% of total home sales, which is fairly normal. Whereas Denver is slightly higher on the new home sales. We're looking at more about 20 to 25% of the total home sales. And frankly, it has helped stabilize the overall prices because builders are more able to keep their prices higher because they have significant advantages of being able to offer incentives in other ways. So rather than lower the home price, what they can do is they can offer extremely competitive interest rates. So often 1 to 2% below what the market rates are going at, or they can offer, new home incentives, whether that be, upgrades, things like that, or, pay for closing costs, etc. So rather than lower the purchase price because they want to keep their prices higher, they offer incentives in other ways. But at the same time, when it's making up 20 to 25% of the total sales market, that also indicates one of the reasons why the overall home sales is not lower in the Denver market in general. The steady new supply has taken pressure off of the existing home sales and has helped Denver avoid a sharper decline. One of the reasons that the existing home sales is still at such low levels compared to the historical average is that the lock-in effect is still affecting the market significantly. What I mean by the lock-in effect is the fact that existing homeowners that are sitting on interest rates in the 2s and 3s don't necessarily have any reason to get rid of those low interest loans to move into a new property at the higher prevailing interest rates. And so they call this the lock-in effect because people that might normally be looking to either move up to their next larger home, or people that might want to right size as they enter retirement and go down into a single story home or a smaller home, aren't making the moves that they normally would because they don't want to lose that low interest rate that they have on the existing homes. So a lot of the existing home sale market is from buyers that have life events going on. And life events are things like divorce, moving, family size increase or decrease, things like that, getting married. but it's life events that are driving it, not necessarily the normal cycle of buy a home, move up to a larger home, downsize into a smaller home as you progress through age. So until we see meaningfully lower interest rates, the Denver market is likely going to continue to see more lock-in effect, which means inventory might slowly rise, but it's not going to skyrocket like we saw in the crash 2007 and 2008, because there's no need for people that are sitting on a ton of equity with really low interest rates to sell. They're not going to be forced to sell, so we're not going to see a flood of inventory. And the reality is, the Denver market, though it might be going through a small correction in certain parts of the market, like attached homes, condos, and maybe some specific neighborhoods that have seen overgrowth, etc. In general, it's seeing more stability and more of a normalized market. So prices are flattening, slightly down in some areas, slightly up in other areas. So I hope this brings a little light to what's going on in Denver, and I'm going to be happy to bring more numbers to you as we go forward. In the meantime, if you know anybody looking to buy, sell, or refinance, or if you yourself are looking to, give me a call. I'd be happy to see if I can help. Stay tuned.